Hello everybody, today we're going to talk about drivers for financial models and why they're important. So first of all, I would like to mention some main principles of forecasting. Of course, the better you understand the business itself and the business and its model, the better you will be able to forecast its financials. Also, of course, all your assumptions and forecasts should be reasonable and logical. In this part, we're going to discuss revenue, costs, capital expenditures, and working capital. So let's start with the revenue. So revenue, if we literally look its definition, is simply the money generated from normal business operations. Usually we see it on the top of profit and loss account. After that, we see costs, which are subtracted to determine net income. Also, revenue is known as sales on the income statement. You should know that, of course, most projections will flow from revenue, and it's really important to forecast it correctly. So we will discuss how to do it the right way. There are many revenue streams. There are 4 of them that we would like to mention here. First of all, we have transaction-based revenue. So usually a business can have one-time transactions, like a customer who comes to a store and buys some products. Also, it could be a big company which signs big agreements on some supplies, and it could be also transaction-based revenue. Also, we could have service revenue if we provide services for your customers. Other types of revenue are project revenue and recurring revenue that are listed here. Let's move further. So the main question here is how we could forecast revenue correctly. There are different ways for doing this that are listed here. First of all, you could look at the management's forecast and simply believe their figures. Also, you can find a lot of equity researches on the company that you are looking at. It's another way for doing that. The third way would be growth rates that we're going to discuss a bit in detail here. So if we simply use growth rates, of course, we need to understand what forecasts we should take into account. And there are different ways for that. We could simply take market growth rate forecasts, so we can just download information about the potential market, about its growth from different agencies that provide us with this data. It's one way. Also, we can rely on historical growth rates and assume that the company is going to grow with the same or maybe a bit less growth rate. It's also possible. And of course, we can also rely on a management's view on growth rates. Also, when we forecast revenue, we can simply rely on its potential market share. In this case, we simply forecast the company's market share forecast, and then we make a forecast of the total market size. And when we forecast the revenue, we simply multiply these measures and get the total result. Also, there is a good way, which is not so often used, but nevertheless, it's moving averages. For instance, if you have monthly data and if you want to get the data for the next month and make a reasonable forecast, you can simply take moving averages for last periods of time. For instance, you can take 3-month, maybe 5-month moving averages. Then you can compare them with the real data and understand what forecast fits better. Then you simply take 3 or maybe 5 last month. You calculate the moving average, and this way you get the forecast for the next month. But as I said, this way is used not so often and only when you have short-term forecasts. So it's not the best way for models. Also, what we can use here is regression analysis. First of all, you need to understand the drivers that affect your revenue. Then you need to get historical data of those drivers. Here we call them inputs. And your revenue is going to be the output in this case. After that, you build a regression on basis of inputs and get a result where you can see that your revenue depends on some figures on some drivers with a certain extent. Here, for instance, we see that revenue depends on commercial expenses and on number of employees. There are, of course, other ways depending on the business of the company that you are going to forecast. And the best way, which is mostly often used in financial modeling, is when you use different drivers and factors. Here, for instance, we have a company that has two products, product 1 and product 2. We see here historical data, which is average price and units sold for both products, for the product 1 and for the product 2. And then we simply make a forecast of those drivers. So we need to make a forecast for the average price, and we need to make a forecast for number of units sold. If we look at different industries, of course, those measures, I mean average price measure and number of units, they're different. And here we see, for instance, that it could be everything, like average product or service price and number of units sold. Also, it could be sales per square meter and number of square meters, which is the case when we talk about companies working in retail, for instance. Also, for instance, if we use data from IT companies, then we can rely on their measure, which is called average return per user, or ARPU. We multiply it by the number of users and we get the revenue. And here is the question, how we could forecast, for instance, the average price measure. There are different ways, and the first one is that you simply use real prices. So you assume that you cannot forecast inflation for your product reliably, and instead of this, you rely on real prices. So we simply take the current price and forecast it for the coming periods of time. Another way is that you simply take historical prices and then you use some inflation forecasts, which could be based, for instance, on the market or on management's view or anything like that. Another way is that you simply use the so-called cost-based approach. When you understand your basic costs and you simply add some margin that you're going to earn on your product. This way you get the potential price that you will have in the coming years. Another way is that you simply rely on some agencies that make forecasts for the market, and you take their data and you input them into your model. And another way that is still possible is that you simply go to the management of the company and ask their opinion on potential average prices for their product. And now we're going to answer the question how we have to forecast number of units sold. There are different ways for doing that. We could use, for instance, historical data and make some growth assumptions. They can be based on our own view, on the view of some agencies that make forecasts, and so on. Also, we can simply rely on capacity limits, because as far as we know, for instance, for different factories, they cannot produce more than some amounts of products. They have limited abilities of production. It's the way for some industries, but of course not for all of them. Then, of course, we can simply rely on market forecasts. We could buy some research from agencies, and then we could rely on their data and make a more reliable forecasts of potential volume of number of units sold. Then, of course, we could rely on the management's view, which is not always correct, but nevertheless, it could be the best way to predict number of units sold. And of course, what we should mention here as well is that when you, for instance, predict revenue, there could be different questions that arise. Seasonality. We usually don't have this trouble when we forecast data on annual basis, but if you want to make a monthly forecast, then you could have this trouble. So there are some businesses that have their revenue fluctuating from month to month. For instance, in December, you could earn more, you can get more revenue, and in other months, it's going to be lower. That's what we should take into account when we make a model as well. Also, another question that we should talk here about is maturation. For instance, if you have a retail business and if you open a new store, then this store, of course, will not reach the planned revenue really fast, because it takes time when customers know about this store, when its revenue grows further and so on. So usually you need to understand that you don't get your revenue really fast, and you should make some inputs about the percentage of the forecasted revenue compared to the whole revenue. And now we move to the next part. We're going to discuss costs, how we could forecast them. And first of all, what we want to do here is that we're going to discuss the general concept of fixed and variable costs. In fact, this concept is the most important in forecasting the company's financials. Of course, we have gone through the revenue, but nevertheless, you need to understand your expenses really well, and you need to be able to forecast them also pretty good. So what is fixed cost, first of all? Yeah? The fixed cost doesn't fluctuate with the company's revenue or production, and usually when we model a business, these expenses will typically either be straight lines or will grow with some inflation. Most common fixed costs include rent, insurance, administrative costs, property tax, and legal expenses. Variable cost. So, variable costs change with the company's production. A common example would include, for instance, the cost of materials, the labor which is used at manufacturing, and some other costs that are directly related to manufacturing and to the company's sales. Most common examples of variable costs include direct materials, direct labor, transaction fees, commissions, utility costs, and billable labor. So when we say billable labor, we mean, for instance, direct labor who get paid for their job directly. So their payment depends on the amount of work they do. And of course, there could be some costs that are somewhere in between. So they cannot be, we cannot say that they're fixed or variable, they're semi-variable. Semi-fixed or simply mixed costs, which means that they include both components, fixed and variable costs. A common example would be, for instance, a cost of electricity. The amount of electricity required to keep the lights on a climate-controlled environment may be almost the same within a certain period of time. But nevertheless, when we increase our production, electricity costs could increase with the amount of units produced, which means that they have both factors inside. They could be fixed at the same time and variable at the same time. The degree to which a semi-variable cost is either fixed or variable can be difficult to predict sometimes, but nevertheless, that's what we need to take into account when we make a model. Here we have a few examples of variable and fixed costs. Yeah, for instance, depreciation. Usually it's fixed, so we understand the amount of fixed assets on our balance sheet, and if we don't have a big capital expenditures program, then the depreciation is going to be almost fixed. Cost of shipping. It's directly related to our product, so the more we produce, the more cost of shipping we have. That's why it's of course variable. Interest expenses. If the company is stable and doesn't grow pretty fast, it means that they don't have a credit portfolio which changes. That's why this company's interest expense is going to stay almost the same. So this cost is going to be fixed in most cases. Then, of course, material used in manufacturing. This cost is directly related to our production. The more we produce, the more material we need to spend. So this cost is also variable. Then we move to salaries. If we talk, for instance, about sales managers, their salary could be directly related to the revenue, which means that it's partly variable. But at the same time, they can have some fixed payments, which means that they could also be fixed. So this cost is in fact semi-variable or semi-fixed. If we talk about the management salary, it's also like in case with sales manager's salary, because this cost could be directly related to the results of the company, to its revenue, and also it could have some fixed part like monthly salaries and so on. Electricity is of course a variable cost which fluctuates with the company's production, but as we discussed before, could also have some fixed part in it. Office utilities, usually it's fixed. Packing supplies for shipping products, usually it's also related directly to our production, and this cost is simply variable. Utilities, like with electricity, these costs could be either variable or fixed, depending on what we're looking at. So for production, it's variable, and when we talk about office expenses, for instance, this cost is usually fixed. Advertising costs could be both variable and fixed, so it's mostly semi-variable. And then life insurance is, for instance, fixed. So how to forecast variable costs? There are three main ways how we can do it. Management's forecast, which is simply that we rely on the data from management and use it in building our model. Two other ways is percentage of revenue and cost drivers that we're going to discuss in detail further. So when we talk about percentage of revenue, we can take historical data. We can look at the percentage that those costs represent in our historical revenue and take this as an assumption for the coming years. It's one way. We can rely, for instance, on the last year that we have, or maybe we can simply take average for a certain time period. Also, we can look at the market and see what other companies have, what their percentage of variable costs is like. It's another way. And of course, also we can simply rely on some data. We can rely on equity researches that forecasts variable costs and can give us a clue how we can forecast our data here. Or it could be also some management's view what percentage variable costs could be in the future. And another way is that you simply look at drivers of your variable costs. So you break them down into number of units and average cost per unit. When we talk about average cost per unit, we need also to understand how we could forecast this figure. We can use simply historical data and look at them. Then we can, of course, add some growth rate depending on inflation, maybe some forecasts that we have on the table. Also, we can use comparable companies and understand what their plans are, what their average cost per unit is right now or is going to be in a few years. And then, of course, we can rely on different forecasts, like different agencies that make forecasts for special industries. If we forecast number of units, we can simply take number of units sold or make some indirect natural measures that are derived from the number of units sold. It's another way, but pretty close to the first one. Compared to variable costs, fixed costs are forecasted in a different way. Usually they are stable and they don't fluctuate pretty much within some period of time. So we simply use historical data, historical costs, and add some inflation rates. Also, we can look again at comparable companies and understand what their fixed costs are and take their data. And another way could be simply direct calculations and forecasts. So we can take data from the management, we can take data from different analysts, or we can go into detail and get more data on the company and make a detailed calculations on the fixed costs. It's also a good way. And there is still a difficult question: how to forecast semi-variable costs. So as we discussed before, it has both a fixed part and a variable part inside. The first idea would be that you simply split those costs into variable and fixed and then forecast each of them separately, like we discussed before. But in the case, if you understand that the most part of your semi-variable costs is presented by fixed costs, then you simply use it as fixed costs and forecast it like a fixed cost. From another side, of course, if you understand that your semi-variable costs look like variable costs mostly, then you forecast them like a variable cost and use the methods that we discussed before for their forecast. And now let's go into detail and understand better how we can forecast different kinds of costs. So let's start with COGS. So COGS means cost of goods sold. This is the direct costs of producing the goods sold by a company. This amount usually includes the cost of the materials and labor directly used to create the good. It excludes indirect expenses such as distribution costs and sales force costs. Here we have a formula how cost of goods sold is calculated. The precise amount depends on the accounting method that you're going to use. It could be either FIFO, first in, first out, or LIFO, last in, last out method of accounting. And of course, your cost of goods sold is going to be different in these cases. But nevertheless, it's not the topic of our discussion today. Let's understand how we can forecast the cost of goods sold. Naturally, cost of goods sold is a variable cost. And of course, it should be dealt with like with variable costs, which means that for forecasting COGS, we can use a percentage of sales revenue method. Here we simply take past figures of cost of goods sold, or maybe gross profit, over sales revenue, and use these percentages to predict future percentages. A more robust model for predicting cost of goods sold would be that you simply split cost of goods sold into raw material, work in progress, finished goods, labor costs, direct material costs, and maybe some other items that are included in this cost of goods sold. Then you simply forecast all these measures separately, and then you sum them up and forecast the whole result. Then let's move to SG&A. SG&A means selling, general and administrative expenses. And usually they're included under operating expenses as a separate line item. SG&A are expenses that are not directly tied to your product. They usually include, for instance, overhead costs, administrative costs, and so on. Now let's understand how we can forecast SG&A. A simple and a clean model would forecast the SG&A as one line item. And the simplest way would be that we take the percentage of sales method. So we look at historical data, we understand what percentage of revenue SG&A was in the past, and we use this percentage for the coming years. Then a more robust model would take your SG&A and break it out into individual components. Then you need to forecast these components separately. Maybe you can have different drivers and forecast them also separately. Here we have, for instance, different costs, and depending on the kind of expenses and their type, they can be forecasted really differently. Rent. So rent is usually a fixed cost. If it's a part of your SG&A, then you simply use the method that we discussed for forecasting fixed costs before. Utilities, again, it's a fixed cost, so forecast it like a fixed cost. Office supplies, again fixed costs, legal costs, usually fixed costs, and sales and marketing, it could be semi-variable costs. So you can get back to the part where we discussed forecasting semi-variable costs and use the methods that are presented there. Payroll. Usually it's also a fixed cost. Insurance cost is also a fixed cost. Now let's move to another part of our lecture and understand better how we can forecast our capital expenditures, depreciation, and fixed assets. Here we have a formula that interrelates all those things together. Capital expenditures are equal to a change in fixed assets plus current depreciation and plus disposals. That's the main formula that we're going to discuss here and talk about. If we talk about capital expenditures, we usually mean that it's the money invested by a company in acquiring, maintaining, or improving some fixed assets such as property, buildings, factories, equipment, and technology. CapEx can be seen on the cash flow statement of the company. It's one of the company's three financial statements. Capital expenditures can tell you how much a company is investing in its growth, how much money it's investing in maintenance of its current activities. CapEx is any type of expense that a company capitalizes or shows on its balance sheet as an investment, rather than its income statement as an expenditure. Capitalizing an asset requires the company to spread the cost of the expenditure over the useful life of the asset. And the decision of whether to expense it right away or capitalize depends on a few factors. And the main factor is the usefulness of this asset. So if you assume that you're going to use this asset within less than 1 year, then expense it directly on the income statement. If you're going to use this asset more than 1 year, then capitalize it. And in this case, it's going to be included into your capital expenditures. That's the general principle that is almost the same for different accounting methods and accounting standards. When we talk about capital expenditures in financial modeling, we can divide them into groups: maintenance capital expenditures and growth capital expenditures. Maintenance capital expenditures are the expenditures that are required for supporting the current activities of the business. It could include, for instance, repair of broken equipment replacement, or maybe some periodic system updates. If we talk about growth capital expenditures, this is the discretionary spending of a company related to new growth strategic plans to acquire more customers and increase its geographic reach. Let's understand better how we can forecast these kinds of capital expenditures. First of all, let's talk about maintenance capital expenditures. Usually, to forecast them, we simply use historical data and assume some growth rate for them. Another way would be simply a percentage of revenue, which is not the best way, but the simplest one. And then we can assume that we're going to maintain our capital expenditures on the level of our depreciation. It's also pretty often used in financial modeling. If we talk about growth capital expenditures, it's not so easy to forecast, in fact. Usually we need a business plan or investment plan of the company to understand what it's going to do, how it's going to spend its money, what projects they're going to have. In this case, as analysts, you of course need to rely on some data from outside. It could be also a management's view on the potential growth capital expenditures because they understand their business better. And if you don't have any of them, if you don't have either a management's view or any business plan, then you can try to predict it yourself, and you can use specific metrics that we're going to discuss here. Yeah, for instance, it could be capital expenditures per square meter. If you understand that the company is going to open a new store, then you can assume how much money is going to be spent on this new store. You simply multiply capital expenditures per square meter by the amount of square meters. Then if, for instance, you need to buy equipment from abroad and as an analyst you need to forecast how much money the company is going to pay, you can find data on prices of this equipment, then understand the required number and multiply those figures. That's the result that you get. And of course, there could be other metrics that you can use as an analyst to forecast capital expenditures better. Now let's understand depreciation and what it means. If we look at the company's financials and its accounting standards, there we could find depreciation method that is used by the company itself. And it could be different. The four methods that are used are the following: straight line depreciation, declining balance depreciation, sum of the years digits depreciation, and units of production depreciation. Let's talk a bit more about them. So straight line depreciation is the method that is mostly used by companies, and it's used pretty often in financial modeling. You simply take the cost of your assets, of your fixed assets, then you subtract salvage value and divide this figure by the asset's useful life. So we see that in this case your depreciation will be stable over the forecasted period of time and will not change. Another way how you can depreciate your fixed assets is a declining balance depreciation method. Here we multiply the beginning book value of your fixed assets by the rate of depreciation. And rate of depreciation can be different depending on your accounting methods. There is a well-known method called a double declining balance depreciation method, where you use 2 over useful life as the rate of depreciation. Another method of depreciation is called sum of the years digits depreciation. We see the formula here on the slide and you can understand the details better. We don't want to go into detail more. Another method is called units of production depreciation. Here it totally depends on your understanding how much the asset can produce in the future, how many assets, how many units of production it can make. Now let's look how we can forecast depreciation. The first method that is used is called useful life. You simply take your fixed assets and you divide them by the useful life of the asset itself. This way you get the depreciation that you're going to use for the coming years. Then another way could be a percentage of your property, plant and equipment, which is similar to the first one. You understand how much of your fixed assets your depreciation is going to be, and then you forecast it for the coming periods of time. The simplest way would be to take a percentage of sales. This method is used when you need to prepare a model really fast and where you don't have a lot of details. It's not the best one, of course, but nevertheless it's used by some analysts. So again, you look at your historical data, you see at your depreciation and what percentage of sales it was in the past, and forecast the same percentage for the coming years. Then you could use depreciation of last years and simply assume that it's going to stay on the same level and forecast it as a fixed amount. Then, of course, you could use some growth rates. You can assume some inflation and simply inflate your depreciation of last periods and get the forecast for the coming years. Then the best way how you can do it is reading the company's depreciation and amortization policy, understanding how the company really accounts your fixed assets. And only then, after forecasting your capital expenditures, you can get the precise method of depreciation and get the precise result. Usually, in fact, the straight line method is used and the depreciation schedule is calculated. Let's talk about depreciation schedule, what it is and how we can created. At step 1, usually you forecast your depreciation for existing fixed assets. It's done pretty easily. It can be, for instance, a percentage of your current fixed assets, and it's going to be stable over the coming years. Then you forecast capital expenditures for different types of assets, buildings, computer equipment, land, etc. After that, you need to forecast depreciation for those new fixed assets. Again, you need to understand that your amortization policy could be different depending on the asset that you're going to have on your balance sheet. And that's why depreciation is going to be forecasted differently for them. Then you calculate the total depreciation for each modeling period, and after that you calculate the net book value of fixed assets. And another thing to mention here is that you need to avoid any mistakes when preparing a depreciation schedule. Which means, for instance, that we need to ensure that the cumulated depreciation doesn't exceed the book value of the asset, as in fact this will result in a negative net asset value on your balance sheet. And this is how in fact our depreciation schedule could look like. Now let's talk about fixed assets in detail. Fixed assets refer to long-term tangible assets that are used in the operations of a business. They provide long-term financial benefits and are classified as property, plant, and equipment on the balance sheet of the company. Examples of fixed assets include land, machinery, buildings, facilities, vehicles, furniture, computer equipment, and so on. Usually when we say property, plant, and equipment and fixed assets, we mean the same, so those terms are used interchangeably. Under most financial accounting standards, the value of fixed assets is recorded and reported at net book value on the balance sheet, which means that net book value of an asset is the difference between the historical cost of that asset and its associated depreciation. To forecast fixed assets, what you need to do is to forecast capital expenditures, depreciation, and then using the formula below, you can calculate fixed assets for the current period. So you simply take fixed assets for the previous period, then you add capital expenditures, then you subtract current depreciation and disposals. And this way you get the result. And now let's move to the next part of our lecture and discuss working capital. Working capital, also known as net working capital, NWC, is the difference between a company's current assets, such as cash, accounts receivable, unpaid bills, inventories, raw materials and finished goods, and its current liabilities, such as accounts payable and debts. Positive NWC, net working capital, means that the company has the potential to invest and grow. And negative net working capital means that the company may have trouble growing or paying back creditors. But in fact, for some industries, negative net working capital is typical. For instance, it could be the case for companies working in retail. In the financial modeling, working capital usually has a narrow definition, which represents only the main accounts that make up working capital in the day-to-day operations of the business. And it includes accounts receivable, inventory, and accounts payable. Let's understand how we can forecast working capital. The easiest way is to use a percentage of revenue. Again, getting back to our last lectures, we simply take historical data of net working capital. We understand what percentage of revenue net working capital was in the past, and we take the same percentage for the coming years. And the more difficult way would be to forecast our working capital taking different factors separately. So we can take accounts receivable, inventory, accounts payable, and forecast them separately. Now let's look at accounts receivable and understand how we can forecast them. The first way is that we take accounts receivable in days, divided by 365, which represents the amount of days per year, and multiply this by sales. To get accounts receivable in days, we need to get historical data of the company, and to calculate it, we take accounts receivable we divide it by sales and multiply by 365, again the number of days per year. Other sources of information to get accounts receivable in days is taking data from other companies that could be from the same industry, for instance. And of course, if you have data from the company itself, if you have sale agreements, you can calculate and forecast accounts receivable more accurately, because you can get access to sale agreements. Now let's move to accounts payable. The principle is the same as with accounts receivable. You take accounts payable in days, divide it by 365 and multiply it by cost of goods sold. And account payable in days can be calculated using historical data. You take accounts payable divided by cost of goods sold and multiply it by 365. Other sources of information for accounts payable in days could be comparable companies from the same industry. In case if you have access to purchase agreements, you can make a more precise forecast and use information from those agreements so that your calculations could be more accurate. And inventory. How can we forecast inventory? The formula is pretty close to what we discussed before. To forecast inventory, you take inventory in days, you divide it by 365 and multiply by cost of goods sold. And inventory in days can be calculated by the following formula. You take inventory divided by cost of goods sold and multiply it by 365. And the sources of information to calculate it could be historical data of the company, or as we discussed, again, you could use comparable companies and take their information. Of course, another way could be analyzing potential needs in inventory for the company. So if you again have some internal data, more information, then you can forecast inventory more accurately and precisely. And now, after we have learned how we can calculate and forecast different parts of working capital, we move to the working capital schedule, which is in fact a summary of what we have gone through. So at the step 1, you put sales and costs of goods sold from the income statement for all relevant periods of time. Then at the step 2, under sales and cost of goods sold, you lay out receivables, inventory and payables. At the step 3, you calculate historical net working capital and changes in net working capital. At the step 4, you populate your schedule with historical and forecast data and maybe some drivers. In this case, it could be inventory days, it could be receivables in days and accounts payable in days. And then you simply forecast net working capital using the methods that we discussed before. And that's how your working capital schedule could look like. So in this video, I'm going to show you how we can calculate and predict revenue using regression analysis. Let's assume that we have the following data. We have historical data of revenue, historical data of commercial expenses, and historical data of number of employees. Now we want to try to make a regression analysis. To do that, we click on data, then we press data analysis, and we choose here regression. We click OK. Then we need to provide the regression with input data. Here it's data concerning our total revenue. Then as input, we use commercial expenses and number of employees. After that, we click OK, and we see the results of our regression analysis right down here. If we take all those coefficients that we got from the regression analysis And if we assume commercial expenses and number of employees for the coming periods of time, we can use the regression to predict the potential revenue for the coming years. So intercept here is almost 37. Commercial expenses, they have the coefficient of 6.7, and number of employees has the coefficient equal to 4.5. Then, predicting commercial expenses, number of employees, we can predict the figures for the coming years. Hello, in this video I want to tell you a bit more about depreciation schedule and how we can build it. So in our case we have 4 years of historical data from 2018 to 2021. And we have information about capital expenditures for the company, about fixed assets and depreciation of the fixed assets. To predict future forecasts for depreciation, capital expenditures and fixed assets, first of all, we need to make some forecasts for capital expenditures. Here we just assume that we were given some data from the management and that they represent some reliable data for our model. Then what we need, we first take current fixed assets and we forecast depreciation for them. We assume that there are 10 years of the depreciation period, and we simply divide the current amount of fixed assets on the balance sheet by 10 and get the result for the depreciation of current assets. It's 1,180. And it's going to be the same for the forecasted period. Then, before we have already forecasted some information, some capital expenditures for new investments, and now we need to build some depreciation forecasts for them as well. Here we have constructed a depreciation schedule where on each line we have depreciation for the assets that were implemented in the corresponding year. So here we have the year 2022, here 2023 and further. So in the year 2022, we assume that for all assets that we're gonna buy on our balance sheet, we're gonna use the same depreciation period, 10 years. And what we do here, we just divide the new investments that we had in this year by the number of years that we're gonna use for our depreciation by 10. And this way we get the amount of depreciation for the assets that were implemented in the year 2022. And the same procedure we do for the other years, for 2023 and so on. Then we sum up depreciation that we have calculated for the new assets, and we combine it with the depreciation that we have received from the current assets. That's the way how we calculate the total depreciation that we use in our model. In this video, we're going to talk about net working capital and how we could forecast it using historical data of the company. So here we have information about the company's sales and the company's cost of goods sold for the periods starting from 2019 to 2021. Also, we have data for receivables, inventory, and payables. To make our forecast, first of all, we need to forecast sales and cost of goods sold. To forecast sales, we use an assumption concerning growth rates. We simply assume that our sales are going to grow by 5% each year. This is a pretty simple assumption, but just for simplification. And this way we can calculate potential sales for the coming years. Then to calculate cost of goods sales, we take the last period's cost of goods sales, look at its percentage in sales, and predict the same percentage of sales for the next years. So it's going to be 29% of the sales for next years. This way we can calculate cost of goods sold. So it's simply 29% of sales for the coming years. After that, we can go and move down here and calculate receivables, inventory, and payables in days. To do that, for receivables, we take average amount of receivables in 2019 and 2020. Then we divide it by sales and multiply it by 365, which means the amount of days per year. This way we get the figure of 55 days, which means that we get our receivables renewed every 55 days. Then we do the same for the year 2021. And we assume that for next years we're going to have the same days in receivables as we had in 2021. Then we make similar calculations for inventory. So we need to understand days in inventory here. We calculate the average of inventory on the balance sheet of the company in 2019-2020. Then we divide it by cost of goods sold and multiply it by 365. This way we get about 167, which means that our inventory takes a lot of time, a half year, to be sold. Then we do the same for the year 2021. We'll calculate it on basis of the calculations that we had a few seconds ago. And we simply forecast that for the coming years, we're going to have the same days in inventory. Then we need to make almost the same calculation for payables. So what we do, we take average payables, then we divide it by cost of goods sold and multiply it by 365. Then we do the same for the year 2021. As we see here, we have about 105 days in payable, which means that we get paid with a delay of about 105 days. We forecast the same amounts of days in payables, 105 for the coming years, and then taking these figures, we need to forecast our receivables, inventory, and payables. To do that, we simply take our calculations. We take receivables, days in receivables, divide it by 365, and multiply it by sales that we have just forecasted in the step before. This way we get the forecasted receivables. And the same way we make forecasts for other years for receivables. Then if we take inventory, then we see that it's pretty the same. We simply take our days in inventory, we divide it by 365, multiply by the cost of goods sold that we have just calculated in the first step, and we get the figure of inventory on the balance sheet. Then we predict and make a forecast for next years here in the same manner, in the same way, and move to payables. We simply take days in payables, it's 105, then we divide it by 365 and multiply it by the cost of goods sold. This way we get the payables for the year 2022, and we forecasted the same way for the years starting from 2023 and further. Then we calculate our working capital, which is receivables plus inventory minus payables, and calculate changes in working capital from year to year. That's the main things that you should know about calculating working capital and preparing a net working capital schedule.